So I'd like to introduce Marco Sammon, who's an assistant professor at Harvard Business School, and he is going to talk to us about passive ownership and price informativeness. So over to you, Marco.
Great. Well, thank you so much for having me. Let me start my timer here to make sure I end on time. I'm super happy to be here. So let's start, with the fact that everyone knows, which is the fact that passive ownership has just grown massively over the past 30 years. So I took this directly from the Financial Times, and it shows that from the 1990s to the 2020s, passive ownership went from essentially nothing to now being about $15 trillion. And this rise came from a combination of both index funds and ETFs. Now, here is my version of the picture, which is saying, suppose we looked over the same time period, right? We know that as passive ownership has grown, there's also been this boom in academic literature studying the consequences of passive ownership, whether it's on price informativeness, investment, all these different things. And most of these things are built on two really common models in finance. We have the Kyle 1985 model, we have the Grossman-Stiglitz 1980 model. And if you look at the number of papers built on these models, I guarantee you it would be identical to the previous picture. And so what am I doing in this paper? Well, in this paper, I'm asking the following question, which is, how does the increased importance of these passive index funds and ETFs affect price informativeness? And I think a natural starting point is the kind of view that you might read in the popular press, in the Wall Street Journal or the New York Times. Here we have an HBS alumni, Seth Klarman, who says, if everyone becomes passive, they think markets are efficient, they stop learning, that's actually going to make markets work less efficiently. And despite this kind of common sense intuition that I think a lot of people can at least intuitively agree with, there's no consensus answer among academics to this question. And so to understand why, I want to just zoom out for a second and think about, what is price informativeness? Well, in some sense, price informativeness is about how well stock prices or any asset prices reflect information about the fundamental value of that thing, right? But then there's the question of how do we actually measure this, right? Well, if we go back to those models that I talked about, like Grossman-Stiglitz 1980, or we go back to Kyle 85, these models have very clear predictions or very clear meanings for what price informativeness should be, something like the conditional variance of fundamentals given prices. But the issue with that is that some of these things are hard to observe in the data. If I knew the fundamental value of Apple, I probably wouldn't be here. I'd be on some trading desk somewhere making tons of money. Right? If I knew that, I also need to know a lot of other things, right? Like the right set of conditioning variables or the right model. And so in this paper, I'm going to do something a little different. I'm going to say, well, let's look at observable quantities like returns, volatility, and trading volume, and think about what these things would look like if people had more or less information. Now, to get some sharper empirical predictions, I'm going to be focusing on a very narrow period. And I want to be very clear. In this paper, I'm making a claim about price informativeness before earnings announcements. Why am I doing this? Because we have a pretty, unambiguous prediction, right? If people didn't know the news comes out, it should be incorporated into prices pretty quickly afterward. And so this is a pretty narrow claim and a pretty narrow zoom in on one particular piece of price informativeness at one point in time. So let's kind of go through, I have three ways that I think about this in the data about how we might measure this. So suppose we have a firm that's going to end up releasing good news, right? When I was in college, one of my buddies had a job working for Wellington Management where he would drive around rural Massachusetts and he would count up RVs and cars in car dealerships, right? And if we have my friend driving around and people are trading on that information, maybe before the RV company or the car company releases that good news, people will trade that good news into prices and prices will drift up ahead of time. And we might see something similar if he sees all those cars are sitting on the lot, not being sold, prices will kind of, drift down ahead of time. On the other hand, if no one's gathering information, maybe prices won't move much before the information is released. And then on the day itself, there'll be a big reaction. And if we see that second case where prices don't really move in the right direction ahead of time, I could argue that the pre-earnings announcement price informativeness went down. Now, I'm not the only person who studied this. This is a trend in academia that every 20 or 30 years, we like to rediscover some old literature and claim it as our own idea. And so this kind of is built on some old stuff from Ball and Brown and Fama, and also some more recent stuff by Brian Weller. And so what do we have here? Well, this is kind of a way to visualize this idea. And to visualize this idea, we need a definition of what is good news and what is bad news. I do something really simple here. I sort firms into 10 buckets based on standardized unexpected earnings. Basically, how big is that earnings surprise at time zero? And I think about, suppose a month before or 22 trading days before, we put $1 into firms that had the best earnings news. Those are going to be the top 3 lines. Or we put $1 into firms that had the worst earnings news. Those are going to be the bottom 3 lines. And we see that in the 1990s, leading up to firms that had good news, they kind of drift up significantly ahead of time. And there's a relatively small move on the day itself. And we compare that, okay, maybe in the 2000s, there's a little bit less of a move. You say, Marco, Reg FD came out in 2000. They changed the way they selectively disclosed information. Fine. So I show you the red line as well, which is saying in the 2010s, leading up to good news, there's almost no move ahead of time. And we have a relatively large move on the day of. And this pattern is not just true for positive news, it's also true for negative news. And I would argue that this is one piece of evidence that for some reason, I'm not taking a stand on what caused this yet, for some reason before earnings announcements, prices became less informative over the past 30 years. Now, the second thing I want to talk about is volatility. Going back to these models, a typically cited source of volatility is new information, right? And we can imagine there's 2 ways that information is going to hit the market. And I like to talk about lumber liquidators versus Peloton, right? Lumber liquidators is a case where someone went and figured out, they're a flooring company, that lumber liquidators was using toxic chemicals in their wood, which was, against the rules, was going to be a problem for them. And they said to everyone, hey, lumber liquidators is doing this really bad thing. And of course, the price dropped. That was private information, right? Collection, and then they made it public. This can be different compared to Peloton, which, in May, when they released their earnings numbers, say, we shut down our factories, no one's buying our bikes, no one's subscribing to our classes. That's a public information release that leads to volatility. And so I would argue if a larger share of volatility is occurring on these public news events, like the Peloton case, that would be evidence that people aren't really doing the work to figure out this stuff before it's made public, and that prices are less informative. And so what I do here, again, is something super simple, is each year for each firm, I add up the squared returns on their 4 earnings days in a year. You can add a little window before or after, it doesn't really make a difference. And I divide this by the squared returns on all days in a year. So this is going to be a number between 0 and 1, which is the fraction of volatility happening on these 4 public information release events each year. Now, this is, 4 days out of 252 trading days. It's about 3%. And so in the 1990s, these days made up about 3% of volatility, right? Their volatility is proportional to the number of days they made up. But for some reason, from the 90s to the 2020s, the share of volatility happening on these public information release days, on these earnings announcement days, has been steadily increasing from 3% to almost 18%. So for some reason, these days are becoming more volatile. I would argue, again, maybe there was a decline in pre-earnings announcement price informativeness. Final thing, and I think this is a little bit less intuitive, but I'm going to try to talk through it, is I'm going to be looking at trading volume. Now, trading volume is something that I think academics still struggle to explain. I think this is the thing that a lot of our models really have the hardest time with. But there's a few intuitions for why maybe if people are trading less ahead of information release events, less ahead of earnings announcements, prices are less informative. Now, of course, we could write a model where it's going to go the opposite way, but I have some other evidence we'll kind of get to later on that. One reason might be, suppose you have no information. Well, maybe you want to wait until the public information release event happens to trade, right? You don't want to trade right before, you want to wait to trade after. Another logic could be, well, price discovery doesn't occur in a vacuum. We need to have at least some trading for information to get into prices. And if no one's trading, maybe prices themselves in and of itself, that lead prices to be less informative. So with that in mind, I wanted to construct a measure of trading volume that's comparable both across stocks and across time, right? People trade Apple a lot more than Dominion Resources. For some reason, they find Apple more interesting. So what I do is for each firm, starting 22 trading days before their earnings announcements, I look at the average turnover in that stock, trading volume divided by shares outstanding, over the past year. And I define abnormal trading volume as, turnover as turnover on any given day divided by turnover over the past year fixed at the start of that 22-day window, right? We don't want that denominator moving around. And I compare this abnormal turnover between 3 different periods, same as before. We got the 90s, we got the 2000s, and we got the 2010s. And so leading up to earnings announcements in the 90s, we see that trading volume doesn't slow down. If anything, trading volume is kind of steadily increasing leading up to the earnings announcement. In the 2000s, we see it's about 10 days before there's this drop. And now in the 2010s, about a month before, 22 trading days before, we see an even larger drop in abnormal turnover before earnings announcements. Again, there could be a lot of reasons for this, but I'd argue maybe this is at least an additional piece of evidence that prices became less informative or are less informative before earnings announcements than they used to be. Now, of course, over the same period, here's my version of that first picture is saying, look, let's look at all index funds and ETFs. Let's add up all the shares they own of all the ordinary common shares traded on major exchanges and figure out what fraction of the market they own. And from the 1990s to the 2020s, they went from about 0 to 15% of the market, right? So over the period that it seems as though prices are becoming less informative, passive ownership grew a lot. And now I'm going to be done. I'm done 20 minutes early. Is this just a coincidence? No, of course not, right? Here's the smoking gun, right? I just put them on the same axis. I have my passive ownership growth. I have my earnings volatility. I didn't even rescale anything. I just put them on there and they kind of line up. I'm done. No, I'm joking. But two trends are not anything here, right? We have to do something more. We have to do a little more work. So the first thing I'm going to explore is the fact that in the cross section of stocks, there's big heterogeneity at any given point in time in how much passive ownership any given stock has. So what I do here is each quarter, I figure out, firms into 4 buckets, right? The top 25% of passive ownership, some middle buckets of passive ownership, and the bottom 25% of passive ownership. And I look at the fraction for stocks in each of these buckets, shares that are owned by passive funds. And so as passive ownership has grown, right, some firms, those firms in the top 25% now have almost 25% of their shares owned by index funds in ETFs. And those in the bottom 25% still have less than 5% of their shares owned by index funds and ETFs. So the first thing we can try to do is exploit this cross-sectional heterogeneity. And kind of a version of that, like a kind of a figure version of that would be, okay, let's look at that earnings volatility picture, right, that I showed you. We showed that was trending up, but let's split that picture into 2 groups. Again, the high versus low passive ownership groups. For both groups, earnings volatility was going up, for sure, in both groups over the past 30 years. However, it went up significantly more for firms in that top bucket of passive ownership. And as that difference in passive ownership between these 2 buckets has grown, right, the difference between the share of earnings volatility on those days, volatility on earnings announcement days has also been growing. Now, this is just kind of a visual intuition. There's a lot of other differences between high and low passive ownership firms, like firm size, age, liquidity. People care more about Apple than Dominion. There's time, trends. So we can throw that all into a regression, try to control for all those observable things, have firm and time fixed effects to get some estimates of how much of the trends I showed you I think can be explained by passive ownership kind of, at a high level. Now, over my sample, the value weighted average increase in passive ownership was about 15%. And so that's kind of the number that I'm going to stick here when we're trying to interpret the magnitudes from the regressions. I'm going to be using this 15% number. Now, from the 1990s to the 2010s, I made one number that kind of summarizes the pre-earnings drift, that summarizes the fraction of information that was incorporated into prices ahead of time. That thing declined on average by about 140 basis points. If we take my cross-sectional regression estimates and we stick in that 15% increase in passive ownership, that would drop the pre-earnings drift by about 70 basis points, or it would explain about half the trend. So again, I'm not saying passive ownership is the only structural change to financial markets over the past 30 years. I'm just saying in terms of explaining this pre-earnings announcement price informativeness, this seems to be an important factor. We can do the same thing with the earnings day share volatility, right? Over from the 1990s to the 2010s. I define it a little bit differently in the exact way in the paper, but it roughly increased by about 15% over my sample. Stick in that 15% increase in passive ownership, that would increase it by about 5.9%. So that's about 40% of the trend would be explained by passive ownership. And finally, for the volume, the estimates I get from the regression are really large. They're even larger than the aggregate trend. If we integrate up the difference in the area of that curve, there must have been some other factors kind of leaning against it, at least in terms of the aggregate trends. But across all 3 of these things, we see a common picture, which is that for some reason, higher passive ownership stocks are associated with less price informativeness. And in terms of explaining the trend, it's, explaining, say, 40 to 50% of the trend across all these. So really economically important factor too. Now, I know what you're all thinking. You're saying, Marco, wait, passive ownership isn't randomly allocated, right? There are some stocks that had more passive ownership, some had less. Maybe passive ownership just happened to increase the most that had the biggest decrease in price informativeness for other reasons, right? There could be reverse causality, endogeneity, and you're totally right. So to that end, I'm going to do two other things, right? I'm going to try to think about increases in passive ownership that happen pretty quickly, that we hope are, plausibly uncorrelated with firm fundamentals, or at least we can identify a control group that's similar enough to those firms that we would expect they'd be similar on some kind of price informativeness dimensions, at least before the treatment occurs. So the first thing I'm going to look at is S&P 500 index additions. Now these firms, according to S&P, are not added for reasons of fundamentals. It's still picked by a committee, but they're to be representative of the US economy. They have to meet certain size requirements, certain liquidity requirements. And so what I have here is I have in the blue dots, what happens to passive ownership for firms that get added to the index? Well, of course, once they get added, they get a big boost in passive ownership. What are the right firms to compare these to? Well, given the criteria that S&P sets out, I'm going to be looking at firms that are in the same industry, that are roughly the same size, and that weren't in the index, and that stayed out of the index at least until time zero. That's going to be the green line. The second control group is going to be firms in the same industry, roughly the same size, that were already in the index. That's going to be the red line. And we see that when you go from being outside the index to inside the index, your passive ownership level kind of goes from the green line to the red line, right? And so what we're going to try to look at is what happens to these measures of price informativeness for the blue, for the blue group, for the firms that are added relative to the firms that either stayed in or stayed out. And it turns out all my results are pretty much quantitatively unchanged when restricting to these quasi-exogenous increases in passive ownership arising from index addition. But I know, I already kind of previewed this, right? You're saying, Marco, there's a committee of people at S&P, 4 times a year they pick firms. The firms they pick aren't random. And that's totally valid. And that's why, again, I have an additional piece of evidence here, which is looking at the Russell Index reconstitution. So how does this work? Russell 1000, roughly 1,000 largest stocks in the US stock market. Russell 2000, roughly next 2,000 largest stocks. When you go from the Russell 1000 to the Russell 2000, you go from roughly being the smallest stock in a valuated index of big stocks to the biggest stock in a valuated index of small stocks. And so your relative index weight could increase by a factor of almost 10 when you're switching between these indices. And so what ends up happening is for firms that go from the 1000 to the 2000, that's the blue dots, they kind of get a boost in passive ownership, versus firms that were just around the cutoff for switching but didn't end up switching, the red dots, they're still following a trend, right? Passive ownership has been going up, but they don't get that discrete increase at the time the index event happens. Now, turns out you can redo all my regressions again. You get something pretty similar using just this quasi-exogenous change in passive ownership. Now, I know what you're thinking. You're saying, Marco, this isn't just the only thing that happens when you switch indices. You also get a change in institutional ownership. Well, in the new version of the paper that's, I just put on my website yesterday, I talk about this, and it turns out, kind of almost unsurprisingly, when you switch between these two indices, your total institutional ownership doesn't really change, right? Because you might be worried, well, institutional ownership is, related to governance, disclosure, all that. But think about it, right? When Foot Locker was dropped from the S&P 500 in 2018, do you think retail people were reading the press release on the website? Do you think they're going out and selling their beloved shares of Foot Locker because it dropped from the S&P 500? No, of course not. These are reshuffling among institutions. So I don't think that the pure institutional ownership effect is driving it. I'm happy to talk more offline about all that. All right. So, hopefully I've convinced you at least to some degree that passive ownership was one of the causes of the decline in price informativeness that we've seen over the past 30 years. But I think kind of the more important question for investors thinking about this is, what is the mechanism? Why does passive ownership decrease price informativeness? And kind of, again, going back to my friends in the popular press, this is a quote from Inigo Fraser-Jenkins, who works at AllianceBernstein. And his kind of story is saying, well, people who are trading ETFs are more focused on macro stuff, right? If you're buying a tech ETF, you're making a bet on the tech sector, not the relative performance of, Facebook versus Google. And so the more people are moving to trading ETFs, the more important we might think that, systematic factors might matter, and the less important we might think stock-specific factors might be. And so what this is really saying is this is really an attention mechanism, right? And if we want to test this, we might be wondering whether or not stocks with more passive ownership, people all of a sudden kind of start paying less attention to. And so the first way I look at that is there's this paper talking about how to measure institutional investor attention. And the way they do it is, it turns out when you type a ticker into your Bloomberg terminal, Bloomberg records that. And so Bloomberg, for every ticker for every day, has a measure of search intensity, which is a measure of, we could say, institutional investor attention, because Marco Sammon can't afford a Bloomberg terminal, right? This is people who are investors at places that can actually pay the $25,000 a year or more for their subscription to Bloomberg. And what I do is this is a visual picture, just kind of a visual representation of things. I have the table in the paper, which you can check out online. But what I'm doing is I'm comparing over time, again, my groups, the top versus the bottom passive ownership. And I have this kind of demeaned abnormal measure of Bloomberg search intensity. And it turns out for high passive ownership stocks, there's been a decline in Bloomberg search intensity for those stocks. And the magnitude actually kind of even makes sense in light of the story, right? A 15% increase in passive ownership decreases institutional investor attention by about 20% relative to the mean. And the magnitudes make even more sense when you think about the fact that, institutional investors make up 70% roughly of the stock market. 0.15 divided by 0.7 is 0.2. So this could be, for every institutional dollar that becomes passive, that's $1 worth of attention that we lost on these stocks. Maybe that's one reason price informativeness declined. Now I'm going to show this quickly and just talk through it, because I'm not the first person to show this. It also turns out, another way to measure attention, which could be not restricted to institutional investors, is downloads of SEC filings. Turns out high passive ownership stocks have relatively fewer downloads of SEC filings. This is also shown by Coles, Heath, and Riggenberg. This is also shown by Israeli and others. So, this is just an additional piece of evidence that people, for some reason, are maybe paying less attention to these stocks. Now, we can imagine there's some equilibrium feedback effect here. Really, this is the demand for information. I'm going out and searching the ticker. I'm going out and downloading the SEC file. But there are people who supply information. And in particular, some people who supply information are sell-side analysts. And again, this part isn't totally new. This is also talked about in Coles, Heath, and Riggenberg, and in Israeli and others, that it turns out that stocks of relatively more passive ownership over the past 30 years have experienced a decline in analyst coverage. But I take this a little bit further, right? And say, well, it's not just the quantity of analyst coverage, but it's also maybe the quality of analyst coverage that might be affected by the rise of passive ownership. And so what I do here is, this is I don't want to show too many regression tables. I know that, they can get really exhausting, especially being on Zoom all day. But I just wanted to highlight a few different things here. For high passive ownership stocks, the first column says there's fewer estimates. Second column says that the analysts who remain, there's more dispersion among their estimates. There's more standard deviation among their estimates. They don't agree as much. Maybe they're not putting in as much effort. Their distance between the true earnings and their estimates, normalized by this increase in dispersion, goes up. So even accounting for their increased uncertainty, they're less accurate than they used to be. And among the subset of those who produce updates, they produce updates less frequently or with a larger time delay. So again, it seems like for some reason, for high passive ownership stocks, these sell-side analysts who are supplying the information, they seem to be supplying both less and lower quality information. Now, this is all great. This is evidence on who's paying attention to what, but are there any other implications we might expect? If fewer people are gathering information, what else might the world look like? The first thing I want to talk about is earnings responses. So just zooming out is, suppose we have a mental model of the world is you didn't gather much information. You have a pretty dispersed prior to how you think the world is going to look. All of a sudden, information comes out. You update your prices, your posterior belief a lot, and then prices need to adjust significantly. And so one way to quantify this is again, rediscovering old literature back in the 90s and 80s. This idea of an earnings response coefficient was a really big topic. And what this idea of this is, you run a regression of the earnings day return, left-hand side, earnings surprise, right-hand side, and see whether or not for a response for a news of a given size, for a given sized earnings, surprise, how much do prices move? And it turns out, again, before we take a stand anything talking about passive ownership, if we run these earnings response regressions in 5-year rolling windows, and we can split it by positive, negative news, systematic, idiosyncratic news, we can do a lot of different splits. It turns out that response to news of a given size has been increasing over time. And it also turns out that a stock with high passive ownership tends to respond twice as much to earnings news of a given size as a stock with relatively lower passive ownership. So again, in explaining this increased responsiveness to news, passive ownership was an important factor. Now, if we go back to the quote from Inigo, however, Inigo was saying this should be a reallocation from idiosyncratic to systematic information. Well, we can test that, right? Again, I know we hate the regression tables, but what I do here is I decompose earnings information into both a systematic and idiosyncratic component. How do I do that? I'm essentially running a regression of earnings on the market and their respective industry. The predicted part of that regression is going to be the systematic component. The residual is going to be the idiosyncratic component. And if we kind of go to that third column, that last highlighted cell, we see that that increased responsiveness to earnings news is coming from that negative idiosyncratic component. Now, why the negative part? Well, this is kind of, I haven't totally nailed this down yet. I have a story in the new version of the draft, which is, well, it's harder to correct over pricing than underpricing. Why? Well, there's frictions associated with shorting. You might get margin called, you have to pay to borrow the shares, but I'm still kind of working out exactly why I think the negative idiosyncratic part of news, it's what's really driving this increased responsiveness to earnings. Last piece is, you're going to say to me, Marco, this is all ex post stuff. This is the way the market reacted when the news came out. Well, it turns out we can also think about a way to quantify an ex ante measure of earnings uncertainty. And the way I do this is with options, right? I follow Kelly, Pastor, and Veronese. They try to study political risk. And the way they do that is they look at options that expire just before elections, options that expire just after elections, and options that expire well after the election. And they look at the price of the options that expire just after the election relative to the ones that expire before and way after. And they argue the reason these options are so expensive is because these options provide you protection against the political risk. There's some election, we don't know the outcome. It's going to have a big implication for the stock market, and people are willing to pay a premium, and it's going to show up in the implied volatility of those options. Well, I do something really similar. I look at, options that expire just after earnings announcements versus those that expire kind of a month before or a month after. And I say whether or not those options are more expensive. It turns out yes. And options that span earnings announcements over the past, since 1996, when option metrics started, have become relatively more expensive, consistent with the fact that these days have become more volatile. Also consistent with, high passive stocks having high earnings volatility, the options that span the earnings announcements for high passive stocks are especially expensive, and a 15% increase in passive ownership would roughly explain half of the trend I'm showing you on this slide here. So again, evidence that even before the information comes out, this increased uncertainty about what information is going to come out is reflected in options prices. All right, so now, make sure we end on time. I'm just going to wrap up. I showed you a few different things today. First, even if you don't agree with me on the cause, you don't agree with me on any of this stuff, there's some interesting facts, right? For some reason, prices don't drift up as much before good news, and they don't drift down as much before bad news. Earnings days are an increasingly large source of annual volatility. And for some reason, now in the month before earnings announcements, people trade way less than they used to. And I would argue this is evidence of decreased pre-earnings announcement price informativeness. Now, in light of the cross-sectional regression results and the causal results with the Russell, index and the S&P index, hopefully I've convinced you that this, was a causal relationship, that at least part of this decline can be explained by passive ownership. And finally, kind of taking a step back, why did passive ownership cause this decline? Well, I argue it's leading fewer people to gather stock-specific fundamental information. My direct effect of that is there's fewer people doing Bloomberg searches, downloading SEC filings. Maybe an equilibrium effect is that sell-side analysts provide worse coverage of these stocks. And I also showed you these stocks have more ex-ante earnings uncertainty and respond more to news of a given size. And so that's all I got for today. I'm really looking forward to the discussion. And again, thanks so much for having me.
Excellent. Thanks very much, Marco. Fascinating. The discussant for this paper is Jennie Bai. Jennie is a professor at Georgetown University. So over to you, Jennie.
Thank you very much, Carol, for the invitation. Share my screen. Wait a second, why is not showing? Okay, let me try one more time. Okay, here we are. Great. This is a very interesting paper. It's well executed over years. I actually see some earlier version of this paper. So Marco did a perfect job in presenting his ideas. I would like to help him advertise a little bit more. So price informativeness is very important. One fundamental question in finance is whether capital can be allocated efficiently across different stocks. And to answer that question on capital allocation, The key is whether price provide accurate signal and whether such signals can efficiently affect the firm's decision on production and investment. Such things have already been talked for many years, as early as from 1970, which is almost a half century ago. But this question becomes even more important today because financial markets have been transformed. So it's totally a necessity to restudy this question under today's new environment. We have known already many new changes in the financial market, like information costs dropped, information availability expanded, trading costs, and investor composition also changed significantly, with institutional investor becomes more dominant. But among all those changes in the financial market, there are two which is quintessential. The first one, which is studied in this paper, passive ownership. The second one is fintech innovation. That is also fundamentally changed the way information collection, processing, and transformation. So this paper, Marco proposed 3 new measures of price informativeness. The reason I quoted new, because these 3 measures indeed are already used a lot in the earnings literature, for example, pre and post earning announcement. But Marco gives them a new perspective. That is how much they can combine the information and the price informativeness by do some variation on these 3 common measures, which I'm going to elaborate in next slides. He showed the price informativeness for his sample, the universe of the CRSP CompuStat sample, has declined in the past 30 years. And he tried to justify the causality using 2 identification, S&P 500 index addiction and the Russell 1000-2000 index rebalancing. In the end, he spent about 10 minutes to suggest some potential mechanism. Particularly, he mentioned why passive ownership could affect such price informativeness is because they decrease tension by sell-side analysts, fewer downloads from SEC filings and lower Bloomberg readership, and all of these things. So my first comment is on the measures. 3 measures: pre-earning drift, earning day volatility, and pre-earnings cumulative abnormal turnover. So the idea of this, of course, is inspired by Grossman-Stiglitz and Kyle's model, is about the share. It's how much of the earnings information incorporated into the price before the event relative to the information incorporated into price when the event happened, which is the timing when the information was released. So based on this idea, it's relatively share is key. Marco defined the pre-earnings drift as a proportion of the 22 days up to 1 day before earning announcement is proportional to the 22 days before until the event day. So this is a share of it. Earnings day volatility is similar. He's checking whether the volatility on the earnings day, which there are the 4 of them in the year, is the share of the earning day volatility compared to the entire year's volatility. And lastly, he tried to understand the pre-earnings abnormal turnover, which is based on turnover compared to the average turnover last year. So I keep emphasizing the idea of the share. Now let's take a close look. The pre-earning drift, which is quarterly available data based on earning announcement. So the share is based on 22 days up to 1 day, which is the pre-earning announcement window. And then looking at the -1 to the 0, that is his day. So it's relatively this share. But for earnings day volatility, this is actually annual frequency. It's based on each of the 4 earning day announcement, which is 0 to 1 in terms of time event, and compared to the entire year, 0 to 252 days. And last one is also based on the pre-earning 22 to 1 days, but they're not comparing anything happening on the earnings day announcement. So my first comment is it possible we can do some mild adjustment, make them more time series consistent? So it's all shares. The first, this is third measure. Shouldn't we use the share of the abnormal turnover on pre-earnings days versus those announcement days? So it's truly not how much during those pre-earnings period, it's the share of it relatively to on the earnings announcement day when it happened. And also you can tell there's -1 to 0, 0 to 1, and also this thing. Can we also, following the post-announcement drift literature, you can unitize this, all of them, maybe all using -1 to 0, 0 to 1, or using the 3-day CAR, which is -1 to 1 about this. So this is a time series consistency I want to mention. If you are studying the time series trend, you can put each of this measure on the left-hand side and examine how they change over time. So the paper can show, yes, pre-earning turnover declined, pre-earning drift declined, and earning day volatility share increased. But Marco definitely not stop there. He ambition to even achieve more in the cross-sectional analysis. So general idea is that stocks with high passive ownership will have a lower price informativeness. Now, we have 3 measures, which is different from literature. They're usually using one combined measure to capture the price informativeness. Now the question comes, in the cross-section, in a given time, do 3 measures imply consistently the price informativeness? If we have 2 groups of firms, one with high passive ownership and one with lower passive ownership at a given time, do those with high passive ownership consistent with the hypothesis prediction in all 3 dimensions? Do they have both lower pre-earning turnover and the lower pre-earning drift and the higher earning day volatility share? Is that what is true? What about if something is not consistent? So one measure, one of the 3 measures is consistent with hypothesis, but the other 2 is not. In such situation, if you still want to say something about the cross-section, how should we interpret the cross-sectional results? That is something I want to see more discussion in the paper, because you want to claim the cross-sectional analysis, which is more complex than the time series one. My main comment is, let me talk about a little bit, give you people, the audience, a review of the price informativeness literature. It's not truly not a singular concept. It's truly about which price informativeness. So Marco mentioned many things, including my paper, showing the price informativeness has trended up over time. But keep that in mind, this is for S&P 500 firms. For them, the market evaluation, the uncertainty, and many of the firm characteristics are relatively stable. I have a lot of things to say for Marco, try to say something here, because I encounter the same challenge when we write this paper. Everyone in their mind have something. They will keep saying, hey, how about this idea? How about that idea? It's truly not price informativeness. So that is forced us to focus on relatively stable firms. Then we move to the S&P 500. If you're looking at our paper in the appendix, we also have the result. If we generated to the universe of firms, which is the same sample as in Marco's paper. So the result is totally changed. If you're looking at the universe of firms, the average price informativeness based on our measure, which is a welfare-based informativeness measure, they do decline over time in the past, not just 30 years, but ever since 1960, over 70 years. And also Fabudi and Laura Veldkamp, in both their AER and RFS paper, they emphasize that the large and high growth firm data becomes more abundant and more valuable. So those price informativeness trended up is mainly due to a lot of this really largest and high growth firms. And this is explained if you're including the universe firms, which many of them, especially since the NASDAQ established, the the capital market flooded in many young and value firms and highly uncertainty firms. And this is one of the comments, I'm pretty sure, Laura, when they do the discussion and our paper, we all encounter the same comment. Many of those small firms, they are different. They are different, could be due to passive ownership, but it could not be. So to really understand this, it's really do a comparison. You need to make the apple-to-apple comparison. Now, after our paper, there are more and more studies on the price informativeness, each of them pointing out something new which might affect the price informativeness. Let me give the audience a few concepts. The first one, investor computation. So the rise of passive investing has led to substantially more inelastic aggregate demand curve for individual stocks. So Haddad and their 2021 paper argue how investor computation this alone will affect the price informativeness. You can say, hey, this is due to the rise of passive ownership, but they can also say this is due to investor computation environment is changed. Yes, these two are not totally isolated. Investor computation is related to the passive ownership rise, but this is a different concept. Others like Marcin Kapchak, who has a study on the investor composition and market power. So they particularly mention price informativeness is non-monotonic. It's decreasing in investor concentration and in the size of the passive oligopolistic sector. So there's one more story. And also information environment. Passive ownership increase short-run informational efficiency for stocks with relatively weaker information environment. Each of these concepts, I can list some more. Investor computation, investor composition, and information environment. All of this more or less related to passive ownership, but they definitely are not the identical concept on the passive ownership. To make sure this paper really stands out, to have a clean smoking gun, it's the rise of passive ownership. A reconciliation with the literature is unavoidable. You need to think about how each of this can be taught. Of course, it's hard because it's endless. What I try to say is price informativeness is not just one concept. It's related to, is that a short-run price informativeness or long-run price informativeness? Is that a price informativeness for large firms or for the relatively smaller firms? If you have different sample and different informativeness horizon, your conclusion will be different. So it's not that important to see, hey, the trend goes down or the trend goes up. The key is to understand why and when the price informatives go up or go down. Those things are going to shed more economic insights to the literature and make the paper make more contribution. And almost lastly, last but last, about the identification. Marco used the S&P 500 index addiction and Russell is imbalancing. This kind of identification is very popular about 5 years ago, around 2016, 2017. But, you know, people getting higher and higher standard. If you're looking at Yan Apple and Todd Gormley and Don Kim's most recent summarized review paper, identification using Russell 1000 2000 index assignment, a discussion of the methodologies, you're gonna understand what I mean. So the key challenge using both of this experiment is the index assignment. They are using this is based on the stock's total market cap, and that is related to the firm fundamentals. This is not absolutely clean measure that the rise of passive ownership is uncorrelated with firm fundamental. And also the stock's total market cap is potential determinant of ownership structure as well. So Marco, you might know this paper, but please give a second look. they offer some discussion, but they also offer in what situation this kind of identification is better, in what situation this identification could be problematic. And I hope you can include those discussions into your paper to make it stronger, because the referee definitely will know this paper and they will point out the same thing as what I said here. So this is a well-executed paper and a study important topic. Marco carefully designed a measure of price informativeness, but I like to see more discussion on the cross-sectional consistency. I would encourage you to think further about how to improve the identification experiment. And last, I don't have time to talk about it. I mentioned two quintessential things in the last 30 years. One is the rise of passive ownership, but another is fintech innovation. You know, you might consider follow-up paper to really differentiating, is that truly the impact of passive ownership or the fintech innovation? Since fintech innovation directly affect the information industry. You mentioned the smaller use of Bloomberg search and the lower, fewer download of SEC. Well, there's new rise up of the alternative data. They might not go to the traditional conventional data, but the usage of the alternative data definitely boosting up. Is that the reason? So to really have clear identification, may need to discussing this too, but it's very ambitious, I know. But you are capable, I'm sure you can do a good job. Thank you very much for inviting me to do the discussion.
Excellent. Thank you very much, Jenny. And I think your last comments there sort of tie nicely. I know you weren't with us this morning, but tied the first and last paper for the day together in terms of the alternative data and the role of passive investing. We're running a little over time, but we don't have any questions, haven't had any questions come through. So before we wrap up, I'll, Marco, give you an opportunity to respond to Jenny.
Well, I don't have a response. I just have to say one thing, which is thank you. I mean, it was an awesome discussion. You clarified all the details that I glossed over in terms of how I measured things. You made a lot of great points about how I could improve the paper. So please send me the slides, and that was awesome. So I really appreciate you taking the time. Thank you so much.
Terrific. So everyone, please join me in thanking all of the presenters for today. So especially this afternoon session, Jenny, Marco, Dominique, and Tom. So we'll wrap up the formalities now. There is a breakout room where you can go and speak more directly to the authors and to the discussants. So if you go back to the conference website, you'll be able to find the link to those breakout rooms. And be able to join the authors and discussants there. So thank you very much, everyone. We'll start again tomorrow morning at 10 o'clock London time. We'll see you then.